Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.
Welcome to another face-to-face, friends. This time it's going to be in English because I have a guest who is very comfortable in English. We say he's comfortable in Hindi also, but he's most comfortable in English. So I'm going to use this opportunity to cater to my learners who love to listen in English. Today, again, we are going to talk about investing. Now, some of you have already started commenting me on the fact that there is a lot of investing oriented videos I'm recording of late. Well, there is a reason. You know that whatever I do, there has to be a reason. It can't be random. The reason is now probably is a good time to go back to the drawing board, to go back to basics and understand the art of investing, because it's not going to be easy for a trader to make money, which has been made in many, many years, last 4 to 5 years. It's going to be tough. But investing, I think the way overall India is progressing, the way things are in global, I think coming 3, 4, 5 years, there's a lot of money still to be made, especially when it comes to small and mid-cap stocks. Stock specific. I'm not talking about indices. I'm only saying there are enough business opportunities in India. If you get into them in the right time, you'll make a lot of money. So in this video today, we are going to meet a fund manager who has been managing funds for the last 10 years. He started his career as an analyst, moved on to become a senior analyst, then eventually a junior fund manager, and now he's managing quite a lot of money for someone. So he's the best guy who can explain us. If he's managing money for other people, he obviously knows the trick of the game. And we're going to learn the trick of the game from him. So let's welcome my guest for today, Aniruddha Sarkar. Hello.
Yeah, thank you, Vivek.
Thank you. Thank you for coming.
It's a pleasure to be on your the face-to-face. And I'm sure in the next couple of minutes, your investors and your audience will enjoy whatever we discuss about the markets. Because I think you aptly put it that it's a good time to go to the basics of investing, because I think that is where we typically in a market which tends to do very well, we forget the basics. We start getting excited about what we hear on the ground. And then when the bad time comes, that is where we regret not following the basics. So I think it's a good time to go to the basics.
Right. And you obviously also narrated to me that, you met someone a couple of days ago and, you want to narrate that to my audience?
Yeah, sure. So I would say that, because I keep meeting investors across the length and breadth of the country. And almost a year back when I had to go for meetings, we had just come out of the bull run, or I would say we were at the peak of the bull run. Almost every meeting I used to go, investors used to give me ideas that, you should look at this company, you should look at that company. Have you seen this company? So now when I go for meetings, the opposite happens. They ask for ideas that, which sector looks good, which company looks good. I think that is where I would say that the easy money making has gone. So that is where I would say it's important to build a portfolio, which is kind of an all season portfolio.
Yeah.
Because typically what happens is when the markets are good, you excitedly make supernormal returns. When the market turns, that is where your returns go down. What really gives an investor a real joy is when your portfolio is consistently able to build returns over a period of time. So that is where I would say an all season, all weather portfolio is what is the most important. And that is, I think we should be able to discuss that today.
Lovely. So I think it's a very relevant topic, especially for my learners who are typically very serious learners who are here for long-term wealth creation. Creating an all-weather portfolio. That's going to be the topic. But in this video, our topic is the gentleman. We get to learn about him, his journey. You should inspire more people because you started from absolutely grassroots level and you're managing a lot of money now. So that whole journey has to be understood. So this video is dedicated to him. And next video will dedicate to how to build a all-season portfolio. Absolutely. So everything about you.
No, thanks, Vivek. So I think, all those people who know me for a long time, like they know that, I have been the other side of investing to getting into the portfolio management. Now, when I say the other side of investing, so very few people, they know that I was not from the equity markets. My family background is not from the equity markets. Nobody in my family before I joined the market used to invest in the market.
Really?
That's a very, very big shock which many people get.
No dining table discussion?
Nobody.
Oh my God.
Purely from a fact that my dad was in the army So all the
Oh,
discussion you can understand used to be around what is happening in the world,
yeah,
etc., etc.
yeah.
And nobody in my family used to invest in the market. I come from a different background altogether. I had the science in my 11th, 12th.
Wow.
So you can say I was one of those Bengali aspirants of, engineering and all.
Yeah.
So it was all about the science up to 11th, 12th. But as I would say, destiny would have it, there was some change of thought and some interactions with some people who had made it good into the finance world. That changed my view that instead of getting into the engineering line, wherein many people used to get into engineering, eventually go for MBA and again into the market, I thought that, why not follow the line of, getting into the bachelor's of commerce.
Right.
And fortunately, I had this opportunity to do my BCom from Xavier's Calcutta,
Acha.
which happens to be one of the top colleges in the country for commerce. And that was kind of a beginning. So I would say my first journey of equity began in my first year of college, wherein I remember in college, our professors used to say that, no, you should read your economic times every day. And if you read economic times, you can't do away with not looking at the page about the markets.
Of course.
And that was a time, I would say, way back in early 2000, wherein you had the beginning of the bull run of that 2004 to 2007. That beginning of the bull run was there, so you could see a lot of excitement in the economy. IPOs were happening, and that was, I would say, the beginning of the journey into the equity markets. Post my bachelor's, I did my MBA. Post MBA, I worked for a brief time with one of the UK based hedge fund. After that, I joined IFL Group in early 2008. Spent a decent 11, 12 years with IFL in different roles.
Wow.
Began as an analyst, went on as a senior analyst, then went on as an associate portfolio manager. Eventually, I launched the IFL Multicap PMS in December of 14, which I managed till December of 19. So 5 years I managed that. And during that period, it had done exceptionally well. One of the top performing multi-cap PMSs. Feb 2020, I joined Quest as the Chief Investment Officer and Portfolio Manager. So broadly, in the next couple of months, I'll be completing the 5 years at Quest also. So I've been managing all the PMS and AF strategies at Quest. So it's been an excellent journey. And one thing which I would keep mentioning this is that anybody in the market who's not from the equity markets, this is a good example that you don't need to be from the markets to get into the markets. Your passion in the markets can develop anywhere. And I think it's all about wanting to learn. Equity markets is all about wanting to read, wanting to learn. And how do you implement it in your identification of companies?
That's so true. That's so true. In fact, I think there are very few such domains or skill set where anyone can come.
Absolutely.
You just
absolutely.
need a good passion and a bit of understanding of the concept, which comes over a period of time.
Absolutely. Absolutely.
So, as an analyst versus as a fund manager, I want to pick your brain on that. As an analyst, life is relatively easier, no? You just have to say, do this, don't do that, write a literature on your thesis, and you are done, right? There is a bit of accountability. Maybe the fund manager who is following your idea will probably say that, ye kya analysis kar rahe ho, right? But once you become a fund manager and manage other people's, how much money do you manage right now?
So right now, I'm managing around 3,200 crores.
3,200 crore. And how many investors would be there behind that?
1,400.
So 1,400 people have given you their hard-earned money and trusting you that you will take care of that money and also generate extra return than market.
Absolutely.
Because all the investors, what they want is if market has given me X return, you will give me more than X.
Absolutely.
Then only I'll invest, otherwise I'll invest in Nifty ETF.
Absolutely. Absolutely.
So how do you deal with these two things where you have to manage the stress of managing the return?
No, I think, I keep saying this to investors also that, taking care of your own money is very easy. The moment you are managing someone else's money, I think the accountability, the responsibility, it goes up multi-folds because you can take risk with your own money, but you cannot take risk with other people's money for the same reasons as you mentioned. It's their hard-earned money, which they have entrusted with you. So I would say that is where any money which I would put into any company, the amount of evaluation of that company is very, very high. Starting from, say, the background check of the management, going into the business model, going into the cash flows, going into the valuations. After getting comfort on all the parameters is when you would get into the company.
Right.
So I would say as an analyst, yes, you are also responsible for identifying ideas because, if you're an analyst, obviously when I began my journey there, So my bosses used to be happy when I used to identify the good companies, which others were not able to identify. As a fund manager, I would say that it is one part is your identification. So you have to wear the hat of an analyst also. You can't be just dependent on others for ideas. You have to work on your own ideas. Apart from that, you also have to wear the hat of a fund manager wherein you decide what which of those stocks will enter the portfolio. More importantly, what weight will have in the portfolio.
Right.
What price you sell, that also becomes very, very important.
Right.
So job doesn't end with identification. Job begins with identification, continues of the weight management, adding weight. You might want to add to your positions because you would have entered at a good price. The stock would have doubled, but even after doubling, you might think there is more upside. You would want to add more.
Right.
But as an analyst, if your stock has doubled, you feel very happy about it.
Right.
So I would say that as a fund manager, if the stock has doubled, you might want to add up more. But then the risk also comes in that what was good at 100 might not be good at 200. So I would say that yes, job is more difficult, but I would say that as a fund manager, you have to wear hats of an analyst also at times.
And obviously also as a business development manager.
Yes,
Because
yes.
a fund manager who's just sitting at his chamber and managing fund, people will know that person.
Absolutely,
right?
absolutely.
You have to be there on the field talking about yourself, talking about the fund philosophy, right?
Absolutely, absolutely. So I would say that that is where I would say PMS AIF demands much more from a portfolio manager compared to say an MF manager, because that is the way the industry is built. Typically, any HNI who's signing a big check of 50 lakhs for the PMS or a 1 crore for an AIF, typically they would want to have an interaction either in person or on a Zoom with the portfolio manager, which typically for a investor putting into a money into an MF, they would not want that. So that is where I would say for PMS and AIF, typically you will find the engagement level is very high.
Yes. And how do you deal with failures? I'm sure you have failures in your life, right?
Absolutely.
So how do you deal with, say, underperformance? Let's not call it failures, because there will be phases when you'll be underperforming and your investor will ask you this question: look at this guy, he's making so much return, what is happening? And some of the Bengalis are really underperforming. So just kidding.
Yes. No, so I would say that in my last 18-20 years of being in the market, and out of that 10 years of managing money, I would say the benchmarks for us has kept on changing. There used to be a time when the Nifty used to do well. So investors used to ask that, your fund should outperform the Nifty, or I should rather invest into the Nifty ETF. Now, when we started outperforming the Nifty, the benchmark changed to NSE 500 because that was a more diversified thing. And that was the time when mid and small cap was doing well. So benchmark changes then. If you beat that, then as you mentioned, benchmark becomes the peers. If you beat your peers on the PMS, benchmark becomes the MFs. So I would say that I'm accustomed to your benchmarks, shifting from here and there. One thing I can happily say is that over the last 10 years, 8 years, the portfolio has outperformed the benchmark. So only 2 years, the portfolio has underperformed the benchmark. That also was the low single digits. So I have not faced too much of that issue of underperformance because yes, as you mentioned, you can't always be in the top performer. But I would say if you're in the top, you can say the top quartile for a long period of time, that is what takes care of your portfolio consistency. So yes, and one thing which is very important is when there is a weakness in the market, or portfolios are not doing well, or market is going through a bad patch, that is where I increase my engagement with investors.
Achha.
Because that is where they want more hand-holding.
Correct.
They want to know what is happening, what is going wrong, etc., etc. And typically when the markets are good, portfolios are doing well, they don't require much engagement. So this is one clear thing which I've mentioned to my team, that on the sales side, that when the markets are bad, we should meet investors more because that gives them comfort that they are in the right hands.
Sahi hai. I think the way you are approaching and the way you are smiling all the time, I think you know exactly how to deal with failures as well as success. So this is about him, and now the next video is going to be released tomorrow, where we're going to go deep dive into his brain and try to know exactly how he picks the stock and what is his philosophy of building a all-weather portfolio. All right. So see you tomorrow. Right? See you tomorrow, 5 p.m. It's a time block for me. Thanks.